All right, good morning, everybody. Thank you for tuning in to another weekly sector spiders report. We're going to take a look at the various sectors that make up the S&P 500, the economic sectors, and just kind of see if we can find a roadmap to the markets. And what I mean by that is we're going to identify important levels that you should be paying attention to, and we're going to identify important trends that you should be paying attention to. And just think of this as like a roadmap. It's not really trade recommendations, although when I do see a trade to recommend, I do it. And unfortunately, the last one I did was in the energy sector. We ended up losing $1, but I'll talk more about that when we get to it. All right, so we have to understand that in the financial markets, there are certain price levels that are more important than others with regards to the amount of supply and demand that exists at them. And also in financial markets, prices are always doing one of three things. They're either going up, going down, or staying the same. So if you have an understanding and awareness of where these levels are and what the trends are, it's going to help your strategy, whether you're a short-term day trader or if you're a long-term investor, it's going to help you do a better job deciding where to enter and exit your positions. I don't follow esoteric, crazy things like hand theory and harmonic charts. I just look for trends and levels. I've been doing this for longer than I care to admit. And as far as some of that esoteric technical analysis, I think it's kind of in the realm of Bigfoot and UFOs. It's fun to talk about, but it's not really credible or believable. And I can tell you that I have never heard a successful or unsuccessful institutional portfolio manager mention things like that. Although I have heard some of them talk about Bigfoot and UFOs, but that's a different conversation. So I've been doing this for 20, 25 years, and over that time, I've built up what I think is a little bit of a competency. I mean, I'm not saying Einstein or anything like that, but I guess if you do the same thing every day for 20 years, you kind of come to the point where you can notice certain things that are going on. So that being said, like people were asking me this weekend, is it time to sell? What do I think? And I am seeing some bearish dynamic in equities, which I do want to point out. And the first thing is that consumer confidence is at an 18-year high. Now, you might be saying to me, well, Mark, what are you talking about? That's got to be a good thing. Well, it's good to a certain degree, but if these sentiment indicators get to too much of an extreme, it becomes a contrary indicator. Now, in this sense, picture this, okay? All these consumers are very confident, the market's been great, blah, 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 so they invest all the money that they have to invest in the stock market. So guess what happens? Now there is no one left to invest. Everyone is fully invested for all intents and purposes. So when someone wants to sell something, there's no buyers around, and sellers could drive the prices down dramatically. There's always going to be sellers because people need to sell for, raising money for whatever, weddings, tuitions, buying houses. You don't have to invest. People don't have to invest, but there's always going to be something that people have to sell something for. So that's the thing with these sentiment indicators. When they get to extremes, they could be contrary. Now, I'm not saying the market's going to crash or anything like that. I'm saying I just want to point out some of these dynamics because maybe they'll help you with your decision-making processes. So we have rising interest rates, which is never good because it makes companies have higher cost to operate. And a big thing too in terms of the market is hedge funds are leveraging based upon interest rates. And if the interest rates are rising, these hedge funds can't buy as much, so they can't get as leveraged. So rising interest rates generally is not a good thing for the stock market, and interest rates have been going up because the economy has been booming and the Federal Reserve has been raising rates. The financials have not participated in this recent rally, and we're going to take a look at that in a few minutes. Basically, the financials have they're pretty much the same level now that they were last March. The technology sector is very overbought. The technology sector is really what's led the most recent rally, and it's the biggest sector in the S&P 500. And when I talk about the market, I mean the S&P 500, just FYI there. So the technology sector is very overbought. Financials haven't participated. interest rates are going up. We could see some extremes in the sentiment area. And then the last thing I want to mention is that oil has gone from 50 to 70 over the past year. And you don't hear anyone on the fake news financial media talking about that, but that's a big move for oil. And again, that's probably because the economy is doing well, so there's a greater demand for oil. But then when the price gets too high, it has negative repercussions. So these are just some of the things you should think about, I guess. I mean, I know I am. But like I said, it's not a fire sale. When we're at a top, we're at a top of like, I mean, a big top, like a top of, 2000 or whatever. When people start saying this time it's different, that's when you got to be worried. Okay. And I recommend a great book by John Brooks. It's called Once in Golconda. Golconda was in fictitious Indian city or city in India where everything was made of gold. And this book is about the history of the market in the 20s. And I kind of came onto Wall Street during the internet bubble and so forth. And if you read this book, you can just see the game has not changed. The names have, but the game hasn't. If you read this book and you change the name of, United Whips or Automated Buggy Company or the companies that were around back then, and you switched them with Netscape and all these pets.com and all these other things from the internet bubble, you can see how the names have changed, but the game hasn't. And one of the funniest things I read about in that book I never realized before is back then they came up with a new term. It was called new error. Like, this is a new error stock. This is a new error business. Those who can remember the internet bubble remember the term new economy. This is a new economy stock. So where are they all now? They're basically pennies if they still even exist. Well, not all of them, but obviously a lot of them. All right, so this is just an overview. We'll skip through this. So here are the S&P, the SPYs. So you can see they're consolidating here. Okay, got a little bit overbought, but did make an all-time high despite all the news about impending economic collapse because of the Turkish lira and trade wars that the media was talking about over the past few weeks, or I should say ranting about over the past few weeks. But yet somehow the market made a new high. And I saw Mark Fisher, who is the famous money manager. I believe he's in Washington, and he knows a lot more about the market than I do, I would say, or at least his areas of the market. And he was saying that trade wars are bullish. So I would put more credence in what he says, or I'm sorry, Howard Fisher. I would put more credence in what he says than some biased politician in D.C. because Fisher has been making money for a long time. And I guess if you think about it, if in a trade war, if it's bad for someone, it's got to be good for someone else. All right. So anyway, enough of that. Short term, I'm going to look for support at the 286 level. You can see that this was resistance in here for the better part of almost a month. The reason why there was resistance there was because it was an all-time top or high back here. So whenever something's approaching a level that was an all-time or a significant high or significant low, pay attention. Intermediate term, if it goes down a little bit farther, I'm going to be watching this 280 level. And you can see the market got there and rolled over 3 times this year. And then it was resistance all throughout here. And one of the things to notice is when the market was here, well, really here and here, it was overbought. So it reverted. And when it got to here, it spent time consolidating. Then it slowly got through. All right. When things are overbought or oversold and they get to important support or resistance levels, pay attention because there could be a reversion and it could be a chance to make a low risk profitable trade. So that's my new trick there. I learned how to erase the lines. It's amazingly easy. You just press E. So anyway, on the downside long term, see this 260 level? Well, every time we got down there, we got oversold. And we reverted. And when I say oversold, what I'm talking about is the market is trading outside of 2 standard deviations of its average price. And that's what these Bollinger Bands are. And As we all remember, I'm sure from calculus or statistics, I mean, and I had to look it up on Wikipedia. But anyway, 95% of all trading should be within 2 standard deviations. So if something gets out of this range, it's time to pay attention. And you could see recently, we got up there and made a new high, but we were a little bit overbought. So now we're consolidating. So again, short-term support 286, intermediate term 280, longer term down here around 260, and I guess there's a chance we could get there. Markets do go up, or markets go up, as everyone seems to be talking about, but they also go down as well. Okay, here's the technology sector. These are the XLKs, and you can see, like I mentioned before, we're very overbought, and this is the sector that led the rally, and this is the biggest sector in the S&P 500. So if these things head south or consolidate, I'm going to be looking for some short-term support here around 74 because that was the top of this range. Next level would probably be 72.50 because that was the bottom here. Next level 71. I mean, it's really amazing how these ETFs just trade at these round numbers, considering how many millions and millions of people are trading them. And it's really a behavioral psychology thing. There's no way an academic can explain how this sector had the same valuation here as it did there. Or no academic or no random walker could ever explain that. But people that trade the markets know that there are supply and demand dynamics in the market that affect prices, and that's really what we're looking at right here. Okay, and this is what I mentioned about the financials, is that they haven't participated in the recent rally. You can see that they're trading right around here, around 28.25, and this was the top of the range since pretty much back in March. So basically, the financials now are right where they were in March. So could be a bearish indicator for the overall market that the financials are not participating. This is a pretty neat chart. This is a pretty neat chart I like to talk about and show people that don't believe in charts, because you don't need to be a market guru to see that this level here is important. All right, so let's go back to 2007, okay? These things topped out right around here. Last January, or this past January, January of 2018, they topped out right there too. All right, so we have an 11-year difference in the market turnover at the same level. So if these things eventually rally back up to this level, I would expect to see some significant resistance there. Okay, this is healthcare. I pointed out this 91.50 level because it was the top here. And you can see, I know this is hard to see, but it's been about a week consolidating. They were trying to get through it. Still broke through it, got into an uptrend. Now, if we see some selling, I'm going to be looking for some support at 92. And if we see more selling, intermediate to longer term, I'm going to be looking for resistance down here. I'm sorry, support down here around the 87 level. All right, and keep in mind the scale here too. These charts are fractal in nature, so don't think that this is more than it is, right? I mean, look at this, 84, 86, 88. So we're talking about a move from 93 to 91.50, which is not significant. But if you're trading stocks in this sector, you should pay attention to this kind of stuff, because say you want to buy healthcare stocks in 3 weeks because your buddy at the club told you should buy them or whatever, and we get back to this level. Oh, wait, I'm going to use my trick again. Ba-bam. All right, so we get back to this level. If it was me and I was going to pull the trigger on healthcare, I would wait. I would wait, because if this thing breaks, there's probably more downside than there is upside from this vantage point or whatever, this time and space. So it gives you more time to think about what you want to do. For instance, if you want to go long and it looks like it's going to hold this level over the next few weeks, all right, fine, then go long. If you want to go long and this level breaks, well, I wouldn't buy anything until it reverted its trend and got into an uptrend. All right, so try to let the market tell you what to do as opposed to just guessing on stuff. And if you don't have a plan, you really are just guessing. Okay, here's consumer discretionary, traded in this range for a few months, 110 to 114. a little bit overbought. Short term, if we sell off, I'm going to be looking for some support around 114 because that was the top of the range. If it breaks through that, intermediate term, I'm going to be looking for support around 110 because that's where the bottom of the range was. Here's the industrial sector, and this is another example of how there are clearly levels in the market that are more important than others. I mean, look at this low, it's 71. 71. So this is May, this is July, and they basically found a low within a few cents of each other. On the upside, 76.50 here, 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 here. So now we've gotten above the 76.50 level and we're consolidating. So what was resistance has become support. But I need to keep, or we need to keep an eye on this because if this thing breaks, it could very easily get back down to 71. All right. So watch this 76.50 level over this next week, see how this plays out. Okay, here's another example. Look at the 53.50 level. It was support back here. It was resistance here. Resistance here. Anyway, we just got through it, consolidating above it. And again, watch this 53.50 level. Similar pattern kind of to the industrials. If this thing breaks, could probably see relatively meaningful sell-off. You know, I mean, I guess the difference between here and here is about 6 or 7%, which is significant, especially if you're on the wrong side of it. The 50 level in the staples is very important. You can see 2015, it was pretty much the top throughout the year. And you might be saying, well, Mark, it looks like it got above it. It looks like it got above it. Well, guess what? Again, remember the scale. This might be 51 or 50 and a half. And there's no fundamental analyst that can say, that can make calls within that, with that precision to a certain level. 50 was the low here. I know this is kind of hard to read, but keep in mind this is a long chart here. Okay, this is 4 or 5 years. So throughout May, the 50 level was the top, and ever since we got through it, it's been rallying. So longer term, and I don't mean next week. I mean like maybe next year, depending on how it plays out. Or if we have a significant drop, I'm going to watch this 50 level because if it breaks, it could go a lot farther. If it holds, we're probably going to see some kind of meaningful tradable rally. All right, here's energy, and this is what I mentioned. I was watching the 74 level because it was so clearly defined. Okay, you see it was resistance here, it was support in June, May, and July, and here, and so my plan was to short this thing. If it broke this 74 level, I was going to short it at 73. My stop out was going to be at 74, and my target was going to be down here at 69. And when I place a trade, I like to have at least a 3-to-1 profit to loss ratio. So in this situation, if I was successful, I would have shorted it at 73 and I would have bought it back at 69. So that's $4. If I was unsuccessful, I would have shorted it at 73 and bought it back at 74 for a 1 point loss. Well, guess what? I was unsuccessful and I covered it here for a loss. But whatever, it's only 1 point, not a big deal. A lot of people are surprised to find out that the most successful traders on Wall Street are only right 58% of the time. So you should never be embarrassed about taking a loss because it's just part of the game. And I think this here could have happened by some kind of anomaly. And when I say that, I mean something like maybe a trade error. And you might be saying, Mark, well, what kind of trade error is going to cause that? Well, let me give you a little possible scenario. Say some hedge fund wants to short 1 million shares of this thing, and they have it in an algorithm to sell 10% of the volume. So be 10% of the volume. So at the end of the day, if 1 million shares traded over the day, they would have sold 100,000. All right. So now let's pretend that somewhere during the day, some other broker puts up a print of say 2 million shares. So now all of a sudden there's 3 million shares on the tape. So this algorithm needs to get from 100,000 to 300,000 so it could still be 10% of the volume. So potentially if the algorithm wasn't programmed correctly or if the trader didn't enter it correctly, the algorithm could get that 200,000 share sell order and just sell it at the market and just puke it right down. Okay, so stuff like that happens all the time and I see it pretty much every day. And that could be the case here, because how could a fundamental person explain how this sector had such a drop in valuation in one day? So anyway, I'm going to pretend that this never happened and just cross that out. And I'm going to watch this 74 level again. And if this thing breaks again, I'm going to use the exact same strategy. Short at 73, cover at 74 for a loss, cover at 69 for a profit. Here's just another long-term chart to take a look at, the energy sector again. And again, you don't need to be a market guru to see that the 78 level is important. It was the exact top at the end of 2016. It was the top here in January. And then most recently in mid-May, it was the top there. So if these things get back up to that level, I'm going to be looking for some pretty significant resistance. Okay, should I yawn now? This is the material sector, pretty boring. Just been trading between the 58 and the 60 level. I would expect that to continue in the near-term future. So I've never really been able to make money off of these things because they're just not volatile enough. But if you can, good for you. But again, if I was going to buy this now for a long-term hold, I probably wouldn't buy it until it got up here. Actually, I might not even buy it until it gets above this level, the 61.50 level, because you can see this was the top here, and this was the top here. So when I say buy it above it, you're saying, well, why should I pay a higher price? Well, the reason is because at that point, the sellers will have been cleared out of the market. So you're having a much lower risk-reward ratio. People want to catch the bottom or the top because they just want to feel smart. It's a natural human reaction. But if you can forget about doing that and cover your emotions or control your emotions, you're going to be much better. And that's one of the reasons why quantitative funds have outperformed humans over the past 20 years, because quantitative funds don't have emotions. All right, and last but not least, here's the utility sector. Also pretty boring, in my opinion. Where it was in this range for like 2 months. I guess this is 53.50. So watch that. If this breaks, I'm watching 52 for support. Longer term, 49 for support. But again, you have to think about the scale. It's really not that big of a move. So, well, if you can make money off utilities, I hope you can. And if so, please let me know how to do it, because I haven't been able to figure it out. All right. That's it for this week, everybody. Thanks. Look forward to speaking with you next week for next week's Spiders preview. Thanks, and have a good week.